In 1998, a hedge fund run by two Nobel Prize winners lost $4.6 billion in less than 4 months. Not through fraud, not through theft, through math they were certain was perfect. Long-term capital management was founded in 1994 by John Meriwether, a legendary bond trader who had built one of the most profitable desks on Wall Street at Salomon Brothers. He did not come alone. He recruited Myron Scholes and Robert Merton, two academics who had developed the mathematical models used to price financial derivatives. Work so significant it earned them the Nobel Prize in economics in 1997, just 1 year before everything fell apart. The fund also brought in former Federal Reserve Vice Chairman David Mullins. These were not reckless gamblers. They were the most credentialed people in the history of finance, and that credentialing was the problem. The strategy LTCM used was called convergence arbitrage. Here is what that means in plain terms. Sometimes two bonds that should be priced almost identically end up with a tiny gap between them, a fraction of a percent. Markets are irrational in the short term. LTCM models told them that gap would always close. So they would bet on it closing, collect a small profit and move on. The problem with small profits is that they are small. To make those tiny margins worth the effort, you have to bet enormous sums. LTCM borrowed massively. At its peak, the fund controlled roughly $125 billion in assets, while only holding about $4.7 billion in actual investor equity. That is a leverage ratio of roughly 25 to 1. For every $1 they owned, they were betting 25. Their models told them the risk was manageable. History was about to disagree. For the first few years, the strategy worked exactly as advertised. LTCM returned 40% to investors in 1995, 41% in 1996, and 17% in 1997 after fees. Money flooded in. Major banks lined up to lend to them at favorable rates because the fund's reputation was flawless. The models had never been wrong. In the world of finance, that kind of track record becomes dangerous because it breeds the most expensive emotion in the market, certainty. Then came August 1998. Russia, struggling under a debt crisis, defaulted on its government bonds. This was not entirely unexpected. What was unexpected was what happened next in global markets. Investors around the world panicked. They did not just pull money out of Russian bonds. They pulled money out of anything that felt uncertain and rushed into the safest assets on earth, United States Treasury bonds. This is called a flight to quality. In normal times, the gaps that LTCM was betting on would narrow over weeks or months, just as the models predicted. Instead, those gaps exploded. The spread between safe assets and everything else widened to levels that LTCM models classified as statistically nearly impossible. Events that were supposed to happen once in the history of the universe were happening every few days. By the end of August 1998, LTCM had lost $1.9 billion in a single month, nearly 40% of its capital, gone in 31 days. The fund's partners scrambled. They called Goldman Sachs, trying to raise emergency capital. Goldman sent a team to inspect LTCM books, and then, in an event that became notorious on Wall Street, Goldman allegedly used what it learned during that process to trade against LTCM-owned positions in the market, an allegation Goldman denied. No charges were ever filed. The situation deteriorated regardless. September 1998 became a slow-motion catastrophe. As LTCM losses mounted, the banks that had lent them money demanded more collateral. To post that collateral, LTCM had to sell positions. But their positions were so enormous that selling them moved the very markets they were selling into. Every sale made things worse. The fund was trapped in a spiral. By mid-September, LTCM had lost so much money that its collapse threatened to destabilize not just its lenders, but the entire interconnected web of global finance. The fund held derivatives contracts with virtually every major bank on Earth. If LTCM failed in a disorderly way, those contracts would have to be unwound simultaneously, potentially triggering a chain reaction of losses across the global banking system. The Federal Reserve Bank of New York intervened. Not with taxpayer money. This is a crucial distinction. The New York Fed convened an emergency meeting of LTCM 14 major creditor banks and brokerage firms, and effectively pressured them into a private sector bailout. The argument was simple: you are all exposed to this fund. If it collapses in the next 48 hours, you will all lose far more than if you collectively inject capital and manage the unwind in an orderly way. The banks agreed. In September 1998, a consortium of 14 financial institutions injected $3.6 billion into LTCM in exchange for 90% of the fund's equity. The original investors were nearly wiped out. The fund was eventually wound down over the following 2 years. The total loss from peak to trough, $4.6 billion. The time it took, roughly 4 months. The fund that employed 2 Nobel laureates, a former Fed vice chairman, and the most sophisticated quantitative models ever built in finance, had failed more completely than almost any other fund in history. The postmortems filled books. Congressional hearings were held. Regulators debated new rules. The core lesson that emerged was not that the math was wrong exactly. The math described normal markets accurately. The failure was in what the models assumed about risk. LTCM models were built on historical data. They measured how assets had behaved in the past and assumed those patterns defined the range of what was possible. When Russia defaulted and the world's investors all ran in the same direction at the same moment, LTCM models had no framework for it. They had no way to account for the possibility that every single one of their trades could go wrong simultaneously. In finance, that kind of correlated collapse is sometimes called tail risk. The things that live at the edge of the probability distribution, the events too rare to model properly, until the day they happen all at once. The men who built LTCM were not stupid. They were not careless. They were perhaps the most intellectually confident group of people ever assembled to manage money. And that was the mechanism of the autopsy. Certainty borrowed 25 times over in a world that does not guarantee anything. The Nobel Prize does not come with insurance. The formula that prices the option cannot price the panic. And when the gap between what the model says and what the world does becomes wide enough, the number that fills that gap is always the same. It is the number on the other side of your leverage. It is everything you borrowed, called back at once, in the worst possible moment, by a market that has never read your model and does not care what it says. $4.6 billion. 4 months. 2 Nobel Prizes. And a room full of the world's most credentialed men, watching their certainty become the most expensive mistake in the history of a single fund.